Hello, students. Are you able to hear me? Oh, that's great. Let me just share the screen. Where is that file? Okay. I don't know. Just hold for a second. I'm just able to manage that. Where is that PDF file? Uh, Why it has opened? Again, it is opening. And participants. I don't know. Students, let me just manage the sharing the study note. We will just continue with the few of the definitions left in the chapter 1 of under custom law. So just give me 2 minutes. I'll just align with the sharing the study notes. It will be convenient to go through the various topics. So let me just align. हाँ ठीक है. Hello students. Uh, Thanks for giving the time. Shall we start? Okay, thank you. So, students, in the previous class, we have gone through the basic definitions that are being used while studying the custom law and understanding the act. Continuing those few definitions, there are 4 or 5 more definitions. Let's complete them. So, that day we left at import report, which is also known as import general manifest. This document is required to be shared by the person in charge of the vessel or the aircraft before, like, landing or uh, reaching the port. It is required, it is supposed to be shared by the person in charge. So with effect from 29/3/2018, this Import General Manifest is also known by the name Import Manifest, Export Manifest, while in case of the import, it is known as import or export, as the case may be. Wherever they occur, the word arrival manifest or import manifest. In case of import, another name given to this document is arrival manifest, and in case of the export manifest, the departure manifest has been introduced. So this IGM is the ultimate responsibility of the person in charge of the vessel, aircraft, or the vehicle, and if it is not being uh, delivered to the custom authorities within the prescribed time under the act, then there is a penalty of 50,000 penalty, which is not exceeding 50,000 rupees. And what is the timeline given for the submission of this IGM is defined under the law under this heading. I hope you have all gone to page number 616 and my note is visible to you, the one I have shared on the screen. Students, please confirm. Okay, thanks, Simran. Uh, Srimant, so sorry. So the timeline or the time limit for submission of this arrival manifest is, in case of the vehicle, there are 3 types of means of shipment of the cargo or the passengers. One is the vessel, that is by sea, aircraft by air, and vehicle by land. So they are talking about that in case there are 2 things, one is the timeline and second is the electronic submission of the IGM. So in case of the vessel, it should be submitted within 12 hours after the arrival at the custom station. Now, this time period at the discretion of the Commissioner of Customs can be extended to 24 hours from the arrival of the vessel or the aircraft. So, in case of the vehicle, this time limit is limited to 12 hours, but in case of the aircraft or the vessel, at the discretion of the Principal Commissioner, can be extended up to 24 hours upon the arrival of the vessel and aircraft. And from 15 amendments made on 10th May 2013, this IGM, like, is to be made electronically in case of the vessel or the aircraft by the person in charge. So in case of the vessel or aircraft, this document is required to be submitted electronically. So 2 things need to be checked in case of the import manifest. That is, one is the time limit by which it needs to be submitted, who is responsible to submit, and whether in which scenario it is permitted or mandatory to be filed electronically. There are 3 things that needs to be remembered in case of IGM. Now, what is the, hope it is clear, IGM, because it is going to play an important role while computing the custom duties, the rate of the custom duty, because there is another document which is based on the submission of this IGM. So the process of computing the custom duty is based on certain submission, based on submission of certain documents. IGM is one of them. Hope it is clear with all of you. Now, another definition is notification. Notification, the understanding of notification is given under subsection 30AA of section 2, which states that it means any notification that is published in the official gazette, and expression notifies also carries the same meaning, and any grammatical variation shall be construed accordingly. That means it should be, grammatical variation should be taken in the same manner as uh, the CBIC wants to convey in the notification. There should not be like, because of the grammatical variation, no different meaning should be interpreted. This is the meaning under this. And tariff value means the, like, first of all, the CBIC is empowered to identify, to fix the tariff values for any class of the imported goods or exported goods. That means the fixing the tariff value for any class of imported goods or exported goods means the duty shall be chargeable with reference to such tariff value. So that means the percentage of tariff, that is the integrated tax, that is the IGST, that will be determined by the CBIC. They are empowered to do that. Now, what is high sea? High sea definition. We have studied the territorial waters, we have studied the exclusive economic zone. Now we are talking about the high sea. Now, high sea is any area beyond 200 nautical miles. We have studied the limit of territorial waters. What is the limit of territorial waters? What is, please suggest or type in the chat box. What is the limit defined in law for territorial waters? 12 nautical miles. Great. And what is for exclusive economic zone? 200 miles. Very good. So, any area beyond exclusive economic zone is your high sea, and it is the international borders. All countries have equal rights in this area, in the high sea area. So all the three levels are clear. No, territorial waters is within the territory of India. That means till the time no ship has entered the territorial waters, they are not like eligible for the custom duties. You can say they are not going to come to the custom ports. We, that question is different, that when we are doing the transshipments, that vessel can come to the port, partial can be downloaded it, and unloaded can carry forward to another international airport. Then that is the scenario of transmission of goods that we are going to study later in this chapter. So, but territorial water is within the territory of India. Now, next is the exclusive economic zone. We have studied and hope the understanding is clear to all. I am moving to the domestic tariff area. Hope it is clear, exclusive economic zone, because if we are going to read each and every line in this note, it is going to take huge time to complete this note. Okay, thank you. So, domestic tariff area. Domestic tariff area means that any land which is within the Indian territory, that will be defined as domestic tariff area. So it means whole of India, including territorial waters and continental shelf. Continental shelf means the seabed that is normally used for the purpose of exploration, or in case there are any minerals, that means for the purpose of economic use. For that purpose, the continental shelves are being used. so that are covered under the domestic tariff area. And no custom duty will be charged for any activity that is being carried on in the continental shelf, that is from the shore to the seabed, but does not include the areas of the special economic zone of the Special Economic Zone Act. Means any area that has been defined as special economic zone under the Special Economic Zone Act 2005 is not uh, defined as domestic tariff area. 100% export oriented units are not covered under DTA. Hardware technology park, software technology park, biotechnology park, these are not under the domestic tariff area. Although they are within the land of the India, but they are not covered under the definition of DTA. Okay. So now we will just study a case law 3. They will just understand whether any transaction that happens from the normal land to the special economic zone, whether a duty is chargeable or not under the SEZ Act 2005, if there is any charge, or the Custom Duty Act 1962, whether the duty is chargeable. This understanding is based on the case decided case law, that is Tirupati Udyog Limited versus UI, which states that custom duty can be levied only on goods imported into or exported beyond the territorial waters of India. Subsection 1 of Section 12 of the said Act clearly states, which is the charging section, which states that the custom duty is not attracted for the supplies made by a DTA unit to a unit located within the special economic zone. So it is clearly stated, when the custom duty is charged, it is only charged when any material is entered through the territorial borders to the land of India, or it goes out through the territorial waters outside the territory of the India. Then only the custom duty is attracted. Otherwise, if there is any movement of the goods within the normal land to special economic zone, no custom duty is chargeable. Therefore, goods cleared from DTA to SEZ is not liable to export duty either under SEZ Act or under the Custom Duties Act. So, if any case law comes based on this understanding, you can refer this case study of Tirupati Udyog Limited. At least you should remember the case laws given in your study notes. Now, they are just in this 27 explaining the part that the understanding of Custom Act 1962 and the Custom Tariff Act 1975. Provisions of these two acts are extended to exclusive economic zone and continental shelf. For the purpose of what activities we are going to do in these two areas is only limited to processing for extraction or production of mineral oils, or supply of any goods in connection with processing of or extraction or production of mineral oils. They are saying that if any material is supplied in that exclusive economic zone or continental shelf, then they are allowed to that areas, and they will not be like chargeable. If yes, the spares are coming from the high sea and they are entering to this area and going to be used in that area, it will equally amount that goods have been imported into India and hence are chargeable to the import duty. Example 5, better we can have an explanation with example 5. Goods imported by the assessee for consumption on oil rigs. Rigs means wells from where we are doing the exploration or extraction, which are situated in continental shelves, exclusive economic zones of India, are deemed to be part of Indian territory. They are not included in Indian territory, they are deemed to be part of the Indian territory. Therefore, the supply of imported spares or goods or equipments to the rigs by the ship will attract import duty. Hence, they will amount to like as if import has happened, and custom duty will be chargeable on those. That means in case of imported spares, if we are supplying already, the spares were lying in India already, whether they were procured domestically or imported earlier, and those spares are being sent to the continental shelf or this exclusive economic zone where already this activity is going on, then that will not amount to import. It is only when the supply is imported, it is coming from a vessel which is entering into the territorial bodies, territorial waters, then only it will attract the import duty. Hope it's clear. Hope it's clear to all.
Yes, ma'am.
Yes, please. No, is it clear or is there any doubt?
Clear, ma'am. Clear.
Okay, okay, thank you so much. Thank you. So, moving on to the definition of the prohibited goods. As the word itself is clearing the meaning, that CBIC has power to restrict certain goods for being imported or export under the law for the timing in force. And these the definition of prohibited goods, like the category of goods is given and schedule 1, and it can be modified at the discretion of the CBIC. So they have just given certain items that these are prohibited, like the given is the obscene material, maps, literature where Indian external boundaries have been shown incorrectly, narcotic drugs. Recently, there was a news that Nepal has shared its map, including certain boundaries of India. Okay, such things are prohibited. You're getting the meaning. Okay, like recently, there was so much narcotics drugs in the case recently in news based on that. Murder mystery or kya suicide of Sushant Singh. Later on, drugs case has been uh, taken care by the NCB, Narcotics Department, Narcotic Control Bureau of India. So such things are prohibited. That's why uh, they are under the eyes of NCB and they are being interrogated because the product they are dealing into is was the prohibited product. So those are the consequences that one has to go through if a person is dealing with the prohibited. Such things, such substances can be counterfeited goods, goods violating any of the legally enforceable intellectual property rights, chemical mentioned in Schedule 1 to the Chemical Weapons Contravention of UN 1993, wildlife products, specified live birds and animals, wild animals, their parts and products, exotic birds, except a few specified ones, beef, uh, tallow, fat, oil of animal origin, specified seashells, human skeleton. So they have just identified the items that are prohibited under the Act. So that means the Finance Act 2013 has expanded the scope of this clause N also. uh, Means these why they are being prohibited, just to protect certain rights related to patents, trademarks and copyrights. So while expanding the scope of this clause, they said that it includes designs and geographical indications so as to provide for protection of these legal rights also, because if you are showing other countries boundary into your boundary, geographical indication, that is going to create a legal right on that land. So that is why these things are prohibited. So central government can now prohibit the import and export of specified goods for protection of designs and geographical indications also, apart from patents, trademarks and copyrights. So they have just included certain designs also and geographical indications as well into the definition of the prohibited goods from Finance Act 2013. So now next is the circumstances of levy. Levy of what? Levy of custom duty. So that means like while studying GST, you must have studied like what is the point of charging or levying the GST. So time of levying of GST is what? The time of supplying the goods or services. And what is the indication, clear indication that yes, there is a supply of goods or services? It is the invoice. So as soon as the invoice is being raised, that means the duty is liable to be charged on the supplies that a registered person is going to make under the GST. So similarly, in the case of customs, there is a time, the event, the taxable event. We just need to identify that point where a person who is importing the goods or exporting the goods is liable to pay the duty to the custom authorities of India. So anytime we are making, anytime like Section 12 of Custom Act clearly states that whenever any person is making import or export in and out of India is a taxable event for the payment of customs, for payment of duty to the custom department. So there are certain points that we will consider while determining this thing, the taxable event for charging the custom duty. Let's go through quickly this. The Supreme Court of India has given there are two judgments. Then there is one more judgment given in and just below the taxable event. Then on basis of these two judgments, we are just reviewing four criteria, 4 points to identify when is the taxable event happening. So whenever there is any case law, we have to just consider these four checkpoints, that yes, when is these checkpoints are occurring, when it happen, when it amounts to be the taxable event. So the first cases, there are two case studies. In these two case studies, same conclusion, same decision is taken by the Supreme Court. One is the case of Union of India versus Upper Industries Limited. All the three cases are of 1999. And second is Garden Silk Limited versus UI. The import of goods will commence when they cross the territorial waters, but continues and is completed when they become part of the masses of goods within the country. What they are trying to say, that as and when they passes the territorial waters, there are 3 points, like when a ship vessel enters to the territorial waters. Second is when they are reaching the port. Third is when they clear the, or they are unloaded. The third situation is they are lying at the port but in unloaded state. Fourth is they are cleared from the custom authority. So which of these four scenarios will be the taxable event, that we are going to study with the help of these three case laws. So in the first two case laws, it has been decided that import of goods will commence. The import of goods start once they cross the territorial waters, but continue. It is in process. The import is in process and is completed. When it completed, when they become the goods that has been imported, they become the part of the masses within the country, and the taxable event being reached at the time when good reaches the custom barriers and bill of entry for home consumption is filed. So in these two cases, what is the uh, event, or what is the point they are trying to say is that the event completes, like the time, the event when the custom duty should be charged. They are saying when the goods reaches the custom barriers. It started when the vessel enters the territorial waters, but the custom duty, the event, the point is when they reaches the custom barriers and the bill of entry is raised. It was concluded in these two cases like that. But there was another case of Kiran Spinning Mills, where the Supreme Court, Honorable Supreme Court, held that import is completed. The word used is completed only when goods crosses the custom barriers. Means once the entry inward document is raised. That means the taxable event is the day of crossing the custom barriers and not on the date when goods landed in India or is entered into the territorial body. That means when the custom has been paid, when the bill of entry is raised, but the custom duty has been paid, processed, and the goods are released for home consumption, then it will amount. Then that point is known as the event, taxable event, and the custom duty is charged at that point. There are scenarios that the vessel has entered into territorial waters, maybe the goods are lying at the port, or maybe bill of entry has been raised, but all 3 points are not the point of taxable event. It is only when the goods are cleared for home consumption, that moment the duty is paid. So what we points we have to consider, the checkpoints are: first is unloading of imported goods at the custom port. This is not a taxable event. Date of entry into Indian territorial waters, again it is not a taxable event. Okay, and then is date on which the goods cross the custom barriers is a taxable event. Date of presentation of bill of entry is also not a taxable event. Yes, the three documents, IGM, entry inward, and bill of entry, these are few documents that later we are going to study to work out the rate of custom duty. So hope it is clear when it is when the taxable event is recognized, it is only the date on which goods crosses the customs barrier, because then only it will be presumed to be import, and then only that is the point we decide ki yes, it is an import and custom duty is leviable. We were just reading this thing under the circumstances when custom duty is levied. Clear? Hope this point is clear. Okay. So now we are considering what is the time of submitting the bill of entry. We have studied the time limit of submitting of the IGM. Now we have studied about the taxable event. We are studying now bill of entry, and we will be studying a document called inward entry. Why bill of entry and inward entry are important? Because these are the two documents, and these two documents are obviously generated on any given date. So the rate of custom duty is decided the later, the date of bill of entry or the date of inward entry, whichever is later is the date of the custom duty. Whatever rate is applicable on that date is the rate of the custom duty that is applicable on any products, the accessible value of the products that has been imported. Okay, so they are again there is a timeline defined for raising the bill of entry. Earlier, subsection 3 of section 46 of the Custom Acts was giving that there is no limit of submitting the bill of entry with the Department of Customs. This so this means there will be no penalty. That means if there is no time limit fixed for submission of the bill of entry, there will be no penalty imposed if there is any delay in the submission of the bill of entry. Like, so later on with the amendment in the Finance Act 2014, here in the below this table you can see with effect from 6th August 2014, this subsection 3 of section 46 has been omitted and a timeline has been defined. The timeline given is that once the goods are delivered, like landed at the port, immediately on the very next day, the bill of entry should be submitted with the custom authorities. Or there is a provision, with effect with the effect from 31st March 2017. There is an amendment which gives a provision that a bill of entry may be presented within 30 days of the expected arrival of the aircraft or vessel or vehicle by which the goods have been shipped or for importation into India. That means एक तो date, one date is given them is immediately the next day when the goods arrived at the custom station. Okay, clear? Second thing is, you know that aircraft, vessel or vehicle is about to reach within next 30 days. So say suppose today we are sitting on the 27th October. So next 30 days are going to get complete on 26th October, or say if it is 31 days, October is of 31 days. So by 25th October you are going to complete that 30 days. So we are expected that the vessel is going to come, any of this vessel, aircraft or vehicle is going to come by 25th. So calculating backward from that 25th date, 30 days. During these 30 days period, one can submit the bill of entry. Bill of entry is given by the importer or its custom agent to the custom authorities. What is the bill of entry? Bill of entry is like one of the document filed by the importer or his customs agent for the purpose of the clearance of the goods. So this is one of the document that is required for the clearance of the goods. So that a importer can file like just within 30 days from the estimated expected date of the arrival of the aircraft, or maximum once it has arrived they can just submit it the following day. Or if there is any resubmission of the bill of entry, then when the bill of entry is returned by the department and again it is submitted, then immediately next day it should be submitted with the department. Hope it is the time of filing of bill of entry or time of submitting the bill of entry with the custom authority is clear. Hope it is clear. Now we will just move on to the calculation of the custom duty, since always whenever we are dealing into cross border transactions, what is we are dealing into the foreign currency. Foreign currency means any currency other than the INR, other than the Indian currency. Clear? Is it clear? Okay, so always we are dealing into the foreign currency. Then even if we are importing or exporting, we have to convert that value into INR, then to levy the custom duty on the assessable value. So any foreign value of the shipment is multiplied by the given exchange rate. Exchange rate is again defined under the law. The exchange rate used for converting the foreign currency into INR is the exchange rate given by the CBIC. Any exchange rate given by any body other than CBIC is not applicable for the purpose of custom duty or anything that is going to be computed under custom law. It is the only exchange rate identified by the CBIC. Okay. Second thing is the custom duty that a person needs to identify for the levy of the custom duty, the department. So for the purpose of identifying the custom duty under section 12, that is a chargeable section under Customs Act 1962, what two criteria they are considering? They are considering the rate of duty at the time of submission of the bill of entry. So just we have studied what is the time limit for submission of the bill of entry. It can be submitted once the goods are arrived at the port, or it can be submitted before 30 days before the estimated arrival date of the vessel. Now, which date should be considered? It is the date which is later of these two dates. Whichever is the later date, whatever is the rate on that date is the rate of basic custom duty applied on that shipment which received on that date. So the rate of BCD, basic custom duty, BCD means basic custom duty, prevailing on that date is applicable. Whichever of these two is later will be used. Exchange rate, again, as I explained, it is only the exchange rate given by CBIC. In case there are multiple exchange rate, maybe at times it happens, then which exchange rate we are going to consider? It is only the exchange rate given by CBIC on the date of submission of the bill of entry. So the two things is which we need to remember is one, to identify the rate of custom duty, we need to consider the later of two dates, the date of bill of entry or the date of what, which is the second date? The date on which the entry invert is granted. Okay, no one had asked me what is entry invert document when it is generated. Anyone knows what is entry invert document? Yes, anyone who can explain what is entry invert document? Okay, entry invert, say the word used is entry invert granted. Who is going to grant? It is the custom authorities. When it is granted, once the IGM, import general manifest or import manifest, has been given by the person in charge of the vessel to the custom authorities. Once the IGM is handed over to the custom authorities, the custom department allows, grants the entry of the material to the port. So that allowance or permission is given by way of document called entry invert document. Hope it is clear now. So now you can better have an understanding what is bill of entry, what is entry invert. Bill of entry is raised by the importer, entry invert is raised by the custom department. So later of these two dates will be the date for deciding the custom duty. Hope exchange rate understanding is also clear. Thanks Urvashi for confirming the understanding. Sorry. Now now they have just clarified key. There is one clearance is done for home consumption. Home consumption can be end user or it can be like a manufacturer is importing certain material. He is going to further process it and selling in the country for the end use. But it is, as so far the custom law is concerned, that import is import for home consumption. Those goods that has been imported are cleared for home consumption only. So subsection 1 of section 47 deals with the clearance of the uh, goods for home consumption. Again they are just going to identify like what is the criteria for defining the rate of custom duty. So under subsection 1 section 47 they says that the proper officer grants that these are goods for home consumption. Such goods are not falling in the definition of the prohibited goods and hence allows or grants the uh, entry invert and permits the clearance of the goods for home consumption. So certain checks are being implied by the proper officer. If proper officer gets satisfied, they permit the clearance of the goods for home consumption. That means an entry invert has been raised by the department. Means CBIC central government may by notification in the official gazette permit certain class of importers to make defer payment, means the payment of the duty at a certain later date. So that is again happens at times in public interest only. Otherwise for a common use for business or trade purpose, duties are not, payment of duty is not deferred. Okay, so now there has been amendment by Finance Act 2017, that with effect from 31st March 2017, that interest provision has been introduced under this, that like uh, once the entry inward has been issued, so inward, so the importer is liable to make the payment of the custom duty. Okay, so there is a situation like uh, a thing called self-assessed bill of entry, and there is a case of a reassessment or provisional assessment. So where an importer makes a self-assessment and raises a bill of entry. Bill of entry is raised by the importer. He makes a self-assessment that because he is not having the accurate exchange rate issued by the CBIC, because exchange rate will be the rate on the date of the bill of entry only, the date, but the importer may not have referred that rate from the portal, and he must have used any rate other than that. So that is the self-assessed bill of entry. If that document goes to the customs, they are just going to verify that rate and the assessable value accordingly. So then that can be reassessed by the department. So if the original bill of entry is returned by the department, the proper officer, then again the importer is required to submit the bill of entry. I hope the timeline defined is within 24 hours they have to resubmit it. So that is the scenario. So the rate of interest is the if the importer fails to pay the import duty under this section on the same day in case of self-assessed bill of entry, and in case of reassessment or provisional assessment within 1 day after the return of the bill of entry, from that means it will count 24 hours only, because they are giving within 1 day after the return of the bill of entry. Then he is liable to pay 15% interest on such duty till the date of payment of the said duty. Means once the self-assessed bill of entry is submitted, then they are liable to pay the custom duty, and if the custom duty is not paid, then they are liable to rate of 15% from the date the duty becomes payable till the date actual the duty has been paid. Or in case if their duty has been deferred, as we have just studied in the amended section of subsection 1 of section 47, that the duty can be deferred by the central government by way of notification, then in that case the date of payment of duty as per that notification, if the duty has not been paid on such deferred date, then 15% per annum rate of interest will be applicable from such deferred due date to the date of actual payment of the duty. Hope, hope it is clear. Okay, so they are saying that this interest duty can also be, this interest liability can be waived off in the public interest by the CBIC. If they feel that any goods that has been imported for the public interest, then they can just waive off these penalties. So with the help of few examples, now we will just see how the basic rate of duty is identified, that which rate of duty is applicable, and what is the exchange rate applicable to work out the accessible value for the purpose of charging the basic custom duty. Hope it is clear. Like the process goes like that. There is a shipment, the value of it is determined in dollars. Then we will just apply any exchange rate, applicable exchange rate as defined uh, under the provisions of law. That foreign the value given in dollars multiplied by the applicable exchange rate will be equal to the accessible value, and on that accessible value we will determine the basic rate of custom duty. That rate is applied to the accessible value, and we get the value of the basic custom duty. This is what we are just going to study from the given example. So an importer imported some goods for subsequent sale in India at $10,000 on accessible value basis. Relevant exchange rate and rate of duty are as follows. Now they have given the two points, the date of such two documents and the exchange rate on these two dates and the basic custom duty on these two dates. Date of submission of bill of entry is 25th February. Date of entry inward granted to the vessel is 5th March. So what is the rule we have studied for identifying the basic custom duty that is applicable to identify the excess to charge the custom duty? What is the rule we have studied? Yes, please. What is the rule we have studied? It is the later date, the custom duty, the applicable custom duty is the duty which is later of two, that is the date of submission of bill of entry and the date of entry inward. The later of these two, the custom duty on that date is the applicable custom duty. So which is the later date of these two documents? Which is the later date? Yes, please. Yes, 5th March. Yes, Brahma. Yes, correct, Shalini. So later is the date of entry inward. That means bill of entry is submitted before the arrival of the vessel and IGA has been submitted before 5th March and entry inward has been granted by the custom authority on 5th March. Hope I am able to clarify the entire process of submitting the documents. So the rate of, on the basis of information given in this example, what we conclude that the applicable rate of basic custom duty is the rate given on 5th March, that is 12%. Yes. Yes, Shalini. So we will use 12%. And what is the exchange rate that we are going to use? What is the exchange rate? What is the exchange rate? Is it 58 per US dollar or 58.75? Which exchange rate we will use to calculate the accessible value? Yes, just we have studied 58 point. Yes, Brahmapa is saying 58.75. Shalini is saying 58. 58. See, just we have studied. We will just go through once again the exchange rate. What it is saying, Brahmapa? That exchange rate of CBIC as on the date of submission of bill of entry. Always the exchange rate given on the date of bill of entry will be the applicable exchange rate. Clear, Brahmapa? Whatever, in later part of this note, we are going to study another document called sub bill of entry. We will never consider even the sub bill of entry. It is only the exchange rate on the date of bill of entry that will be considered. Hope it is clear. So the exchange rate we are going to use is 58 per US dollar. So continuing with the answer is the relevant day rate of duty for imported goods is 12% by, because the later of two dates will be considered. Exchange rate is 58 because the rate on the date of submission of bill of entry will be considered. So accessible value is, once we know what is the exchange rate we have to apply, we will take the dollar value of the shipment multiplied by the exchange rate. Accessible value comes to 5,80,000 in the given example. Then what is the custom duty? The rate of custom duty is 12%. So 12% will be applied to accessible value. 12% on 5,80,000 will come to 69,600. Then, in case of imports, another charge called social welfare surcharge is charged on basic custom duty at the rate of 10%. This social welfare surcharge is only applicable in case of imports. In case of exports, there is no surcharge. Okay, only export duty is worked out, no surcharge, no provision of surcharge. So it is only in case of imports, always social welfare surcharge is calculated at the rate of 10% on basic duty. The amount of basic duty is 69,600. 10% of this amount is 6,960. So basic duty is 69,600, social welfare surcharge is 6,960. Now IGST. IGST, okay. In the question above, just we have seen, we just missed to read this information. Integrated tax leviable under subsection 7 of 3 of Custom Tariff Act 1975 is 18%. Just above in the definitions, we have studied that in this Custom Tariff Act, various tariffs for various products has been given. So this Tariff Act talks about the rate of IGST. Okay, applicable in case of the import shipments. So the rate of IGST is 18%, and this we work out on the total value of the shipment, that is 580 plus 69,600 plus 6960. Can anyone quickly work out the IGST amount? Is it telling? Can anyone please work out? If 5,80,000 plus 69,600 plus 6960 and then 18% of that value. Is it reconciling? Yes? Anyone has worked out? These are important things that you should remember, because in exam they are going to ask you to compute these things. These are going to be the things for a very complex problem. Small parts, in small parts you have to utilize this, apply this law like this. So moving further, like then what is the total amount of custom duty? Just we are going to add these three taxes. That is going to be the total custom duty. If in question ask you what is the total custom duty, then you have to tell like this only. So now taxable event for warehouse.
Excuse me, ma'am. Excuse me, ma'am.
Yes.
Is it not double taxation that we have to pay IGST on custom duty also?
Yes, so far this is concerned because they have just counted that custom duty, whatever is charged, is for the is going to add into the value of the product only. This is going to be a part of the product only. So that is why they have just worked out IGST on this part also.
Okay, ma'am. Then this IGST will be subject to input credit also, na?
Yes, yes, IGST charged on this is eligible for input tax credit.
Okay. Thank you, ma'am.
Okay. So as I was just narrating you that there is a situation when sub bill of entry is being issued. It happens only when goods are unloaded and are cleared. Like means they are not cleared. The custom duty has not been paid yet, but they are just cleared for the purpose of storage into the custom bonded warehouse. Okay, then from the custom bonded warehouse, the importer submits the sub bill of entry to get the goods cleared for home consumption. Okay, so now you will see there are another date is added into the transaction, the date of sub bill of entry. So, but while identifying the applicable exchange rate, it is always the first bill of entry that has been um, given by the importer to the Department of Customs for the purpose of clearance of the goods. That is only thing that initially he has not given, means he has given an instruction not for a home consumption, just for uh, clearing the goods to be stored into the custom bonded warehouse. Okay, is it clear? So now, but they are saying that the rate of duty, custom duty, it will be the date of sub bill of entry. So for the purpose of exchange rate, it is only the bill of entry, but for the purpose of working out the rate of custom duty, it is the latest of the two dates. It can be bill of entry or sub bill of entry, or the that inward entry. So definitely goods have already cleared, bill of entry has been raised, but since the goods are into the warehouse, and now by submitting the sub bill of entry, you are clearing the goods for home consumption, then that date will be considered to determine the rate of duty. Hope it is clear. So they have just given scenarios like how we have to just consider the uh, dates for identifying the basic custom duty. So they have just covered the scenarios like this. The goods, first case is goods entered for home consumption under section 46. That means the goods are cleared, bill of entry is raised, and goods are cleared for home consumption. Then that, in that case, the later of these two dates, the date of presentation of bill of entry and the date of issue of entry inward by the department. Second scenario is goods cleared from a warehouse under section 68. Just we study the scenario where the goods were in the custom bond warehouse, and from there it is cleared for self consumption. In that case, the document submitted is sub bill of entry. That date is going to be considered for the purpose of identifying the basic applicable basic custom duty, the rate of custom duty, sorry. And in any other cases, any other goods, the date of payment of duty, whichever date you are making the custom duty, paying the custom duty, that rate will be applicable. Hope till now it is clear. This understanding we are just going to go through with the help of example number 8. Okay, so now they have given 3 dates. Quickly I'm just going reading this question. An importer imported some goods, entry inward granted to a vessel on 7th February. So department has given entry inward on 7th February. The goods were cleared from Chennai port for warehousing on 8th February. So goods were stored into the warehouse by 8th February. After assessment, the bill of entry was presented on 1st February. So the date of presentation of bill of entry is 1st February. That is before the date of granting the entry inward. Now, assessable value was $10,000. Assuming that no additional duty is payable, the goods were warehoused at Chennai and were cleared from Chennai warehouse on 4th March for home consumption. Home consumption word is not written, but it is implied that yes, when the goods are getting cleared from warehouse, they are going to clear for home consumption. What is the duty payable while removing the goods from Chennai warehouse on 4th March? Exchange rate and the rate of custom duties are as follows. So they are just asking you which is the basic custom duty that is going to apply. So they have given 3 dates: date of submission of bill of entry for warehousing, date of entry, and date of clearance of the goods from warehouse. So which basic custom duty rate will be applicable in this scenario? Yes, please. Which date we are going to consider? Which date we are going to consider? Just we have studied. Just we have studied 3 scenarios. These are the 3 scenarios. Yes. Yes, Mr. Sharma, the date is 4th March. That is applied for the purpose of basic custom duty. We are going to consider 12th March because this is the date when goods are cleared from warehouse for the home consumption. As we have studied in the table above, this case falls under point number 2, that is goods cleared from a warehouse under section 68. In that case, the date of presentation of bill of entry, actually they have just written bill of entry, actually it is the sub bill of entry, the date of presentation of sub bill of entry for home consumption. So the only checkpoint you have to see is when the goods are getting released for home consumption. Is it the point when the original bill of entry is raised by the importer or his agent, custom agent? If at that point itself the goods are getting cleared for home consumption, then that date are the entry inward date, whichever is later. On that date, whatever rate of custom duty is given, that rate is the that is rate we are going to use to solve our question. And in case that first bill of entry is being raised to clear the goods for the purpose of storing into warehouse, then that date will not be considered. The date when the goods are getting cleared from warehouse for home consumption, and for that clearance a sub bill of entry is raised, the date of that sub bill of entry should be considered and should be compared. That means there will be no question of comparing because entry inward has been issued long back, because goods are already cleared. The first step is cleared, but that clearance has happened for the purpose of storing into warehouse. So already the entry inward date has passed away. So only date we have to consider is the date of the sub bill of entry. So in this case, it is 12%. Hope it is very much clear to all of you. Like I have been repeatedly using the same thing, explaining the same thing. So it should be clear to all of you why we have chosen 12%. Hope it is clear. Please confirm this understanding, because repeatedly when you are doing the complex things or any numerical question related to determining the custom duty, what you have to see whether it is a prohibited good or not, what is the taxable event, then uh, what is the rate of custom duty, what is the exchange rate, what is the rate of the GST. So that is why we are studying all these things. Thank you so much for confirming. These are the basics. And what is the exchange rate that is applicable in the given scenario? What is the exchange rate? Is it 60, 59 or 55 per US dollar we are going to use to work out the accessible value in INR? Accessible value in dollars is given in the question. We are using the exchange rate to convert the accessible value from dollar to INR. Why 55 we are going to use? Why we are using 55 and not the other, any of the other two exchange rates? Yes, please. Please answer. Correct. So always, as I stated earlier also, आंख बंद करके जिसको कहते हैं, the exchange rate given on the date of bill of entry. We are not considering the sub bill of entry. It is only the bill of entry. Okay, that will be the exchange rate we are going to consider. Hope it is clear to all. Hope it is clear to all. Please confirm. Students, please confirm and quickly confirm if the understanding is clear, or if you have any question, please raise your question, because it helps me to move ahead. to take to move. Okay, thanks all for confirming. So we'll just review the answer. See, the rate taken is 12%, the exchange rate taken is 55. The explanation given is the rate applicable on the date of submission of the bill of entry by the importer. And similarly, in the question it is given, will assume IGST at the rate of 12%. Normally, IGST rate will be given in the question. If it is not given in the question, just mention in notes assuming IGST at the rate of 18%, the total value is this much. But normally it is given in the questions. Okay, at times if you want to assume, the assumptions can be made. So with this, we complete the process of levying the custom duty in case of imports. Clear till now? Okay, so first we need to identify whether it is an import or not. Then we will just consider those 4 criteria we have studied that helps in identifying the taxable event. Taxable event is once it is the shipment clears the customs barriers. When the import process starts, once the vessel enters the territorial limits, territorial water body. So then the process of import starts, but it gets completed only when the shipment gets clear from the custom department, when the custom duty is paid. Clear? And then we have just studied the rules for identifying the basic custom duty, the rule for time limit for deposit of the bill of entry, the time limit you should understand the date of filing of the IGM, then when the entry inward has been raised by the custom department, and the rule of identifying the applicable exchange rate and the rate of the IGST. These are the few things you should remember, or rules you should remember to work out custom duty. Okay, so now moving to taxable event in case of export duty. As I said earlier, there will be no surcharge charged by the custom department under Custom Act. It is only the basic duty which is identified or addressed as export duty. Okay, so in case of imports, the entry inward document is being granted by the custom department or the proper officer under the act. In case of export, the document granted by the proper officer is entry outward. Once the entry outward document is raised by the proper officer, that means he has given the clearance for loading the goods, okay, to the vessel. And once this document has been raised and goods have been loaded, the goods will amount, that is the point, that the duty will be, export duty will be charged, and goods will be termed as exported. That's the reason we have just studied the definition of export, exported goods, exporter. Okay, so what is the rate of duty that will be applicable in case of exports? It is the export duty rate prevailing as on the date of the entry outward. In case of the imports, we were considering 2 dates. Later of those 2 dates is the date of the custom is the date for identifying the rate of custom duty. But in case of exports, it is only the date of export outward. Oh, sorry, entry outward date, when the entry outward document is raised by the proper officer. Hope it is clear to all. Thank you, Urvashi. Moving to example 9. And assessee, they are again with the help of examples trying to clarify the law, what it is written. An assessee submitted the shipping bill on 1st January 2014. Okay, at that time the export duty was nil. Very good example. So when the shipping bill, like bill of entry is being uh, submitted by the importer. Similarly, in case of exports, the shipping bill is submitted by the exporter. Hope it is clear. Okay. In case of the shipping bill, the buying rate of CBIC is applicable. See, when we are talking of exchange rate, there is always one rate is buying rate and one rate is selling rate. You must be hearing these two rates, must be in news, or when you are dealing in shares or like that, there is one rate called buying rate, and in any other transaction also, just forget about those things. Like when you're buying any simple product from the market, there is one rate, and when you want to sell the same product, there will be a different rate. So one is called buying rate, another is called selling rate. So always in case of imports, the rate applicable is selling rate. See, if we go to CBIC website and just check the exchange rate, the two rates are given, selling rate and buying rate. Now the question is which we should consider in case of imports. So in case of imports, we always consider the selling rate. Hope it is clear. I'm just trying to give some practical exposure also while studying the law. Okay, so in case of imports, it's always the selling rate, and if in case of exports, the exchange rate applies to the buying rate of that date, of that the date on which that export outward entry outward has been raised by the proper officer. So coming back to example 9, a shipping bill was raised on 1st January 2014. At that time, the export duty was nil. Matlab, it was a duty-free product. Let export order entry outward was granted on 5th January 2014. However, due to some problems, goods could not be loaded into ship. Hope you are having a understanding of the question of the scenario. What they are trying to say is shipping bill submitted on 1st January. Proper officer granted the entry outward on 5th January. But in spite entry outward has been granted, the goods were not loaded into ship. Some problem happened. So till this point, it will not amount to export. Okay. On 25th March 2014, the shipping bill was voluntarily resubmitted by the assessee with the request to permit the shipment by a different vessel. Now, just whosoever wants to export the goods, their product is lying at the port itself, they are not able to load it. Then they said, okay, maybe there is a problem of the vessel because of which the goods were not loaded when the this export entry outwards was granted on 5th January. So exporter resubmitted the shipping bill and request to ship the goods by a different vessel. Subsequently, on 27th March 2014, let export order was granted. So since the goods were not loaded to the vessel earlier, there is no sanctity of the earlier entry outward granted by the proper officer. When a revised bill of shipping bill has been submitted by the exporter, then again the proper officer based on that request will consider grant this entry outward. So on resubmission, the entry outward is granted on 27th March 2014, 2 days after the submission of the bill, revised bill. Now, let export order was granted. Proper officer approved and granted. In the meantime, the duty at the rate of 12% ad valorem was levied with effect from 1st March. Initially, in the question what you have studied, it was duty was nil. That means the goods were duty-free goods. Okay, but from 1st March, rate of duty, now this good falls under 12% of custom duty. So when the this entry outward is granted, when the entry outward is granted, this time It is 27th March, correct. That means when the entry outward is granted by the proper officer, already this product falls under the a certain rate of duty, that is 12%, because it became with effect from 1st March 2000. So now this product, since it is the proper officer, the entry outward has been granted on 27th March, later than 1st March. Hence, now this product is eligible to pay to or liable to pay the duty. Okay, this is how you have to analyze the situation. Okay, so in the given case, actual export took place only after revised shipping bill was submitted on 25th March, for which entry outward granted on 27th March. Hence, the rate prevalent as on date of the entry outward granted to the vessel is relevant for determining the rate of the duty. Hence, the assessor is liable to pay the duty at the rate of 12%. Hope it is clear, students. Okay, thank you so much. So, likewise, in imports, as we have studied two things. One is the basic rate of custom duty, second is the exchange rate. As we have studied in imports, the same thing will we have to see while making export of goods. Now, which exchange rate is applicable as stated under sections 50 of this custom act? In case of export, rate of exchange of CEBC, abhi to CBIC, as in force on the date on which shipping bill or bill of export, as the case may be, is presented. So that means, again, which date? Like in case of import, it is the date of the bill of entry. In case of export, it is the date of shipping. Hope it is clear. Okay. So in our this foreign trade policy also, it has been considered that for every export from India, we are going to consider the FOB value, and for every import, we are going to consider the CIF value. Okay, so do you all have understanding of FOB and CIF value? Understanding of FOB value and CIF value? Yes, okay, Rakshita, good. So, whenever an exporter is bearing the charges till the point of boarding material to the ship, that is known as free on board, because that is from the importer's point. Like I am exporting certain consignment for some uh, US country, one of the US countries. So for US, those goods, if I paid all the charges till the goods are boarded on the ship, then that consignment is called FOB. I have not paid the insurance charges or freight for the uh, shipping of material from Indian port to US port. Okay, the exporter has not borne those expenses. Such expenses, when it is borne by the importer, then the importer says that the goods are received at CIF basis. Okay, so that means CIF basis is cost, insurance, and freight is covered. So it means once goods are reached to the importer country port or airport, importer has to pay cost, that is FOB value, along with insurance, freight from exporter country to importer country. But in India, for the purpose, say on an invoice, on a document, the CIF value is mentioned. So to charge the export duty, as it is defined under export policy also, It is only the FOB value that is considered for charging the export duty. So what we will do, from the CIF value, we will deduct the value of or the amount towards the insurance cost or towards the freight cost. And we derive the FOB value. On that FOB value, the export duty is charged at the rate, that is the rate on which the export entry outward document is granted by the proper officer. This is a very clear depiction of FOB CIF. See, cost of incurred by the exporter is like if you are manufacturing any garment, so there will be the cost of raw material, but you need to export the garment, so there will be certain overheads or certain other costs that will be incurred to convert that fabric into a garment. Then shipping, bringing that garment from the factory place to the port, you're going to incur some cost towards freight. Again, there is a risk that anything can happen, damage can happen to the vehicle and hence to the material product also. So you need to get the shipment insured, inland insurance you are supposed to take. Then whatever value you are getting, that is the FOB, free on board value. Okay, so they are showing that exporter is from India. They have given the map of India, and insurance freight up to the export port. From any place in India, you are taking to the port of export. What all insurance and freight you have paid till the port of export will form the part of FOB. Then from the port, goods are exported on FOB basis to any importer in USA. So the goods are landed at CIF value. That means the FOB value, the cost incurred till the export port by the exporter, plus the cost paid by the importer towards insurance and freight will be added. So that is why CIF. C stands for the FOB price to the importer. Insurance, I for insurance and F for freight. This is how CIF value. So once the goods reach to the US port, it becomes CIF value to the importer. Hope this is clear to all, this depiction. You will never get confused between FOB and CIF value seeing this picture. Okay, Chetan, thanks for confirming this understanding. Now moving to example number 10. Now they are asking, compute export duty from the following data. Again, they are going to give few dates, they are going to give exchange rate, they are going to give you the rate of export. So FOB price, they have kept $1 lakh. Shipping will present it electronically. As we have stated that it is mandatory, so it has been presented electronically on 28th February 2018. Proper officer passed order permitting clearance and loading of goods for export is 1st March 2018. Rate of exchange and rate of export duty are as under. So in the above 3 points, only two dates are given. One is the date of shipping bill. Second is the date of the entry outward. So what we have studied, which rate of duty will be applicable? Which rate of duty? Yes, please. Please share your understanding. Which is the rate of duty? On which date? On which date? Just we have studied. Yes. Yes. Because the law has just stated only one date in case of exports, that is the date of entry outward, when proper office approves and grants the clearance in the form of entry outward document. Okay, so it is the 8% export duty applicable in this scenario. And then what is the exchange rate? Okay, I have just scrolled down. No problem. The exchange rate, as in case of the import, it was the exchange rate on the date of bill of entry. Similarly, in case of exports, the exchange rate, applicable exchange rate is the rate on the date of shipping bill. Hope now it is very clear, like how you have to identify the applicable exchange rates in case of import and export, and the applicable rate of custom duty in case of import or case of export. Hope it is clear. Okay, Urvashi. So the computation, I think so it is very clear. Like FOB value was given in question 1 lakh, the rate applied is 65, the accessible value in INR becomes 65 lakh. Custom duty is say 5 lakh 20,000. Matlab, worked out at the rate of 8% on the accessible value. And this is the total value of the export.
Actually, ma'am, it is not subject to GST. No GST will be chargeable, no?
No GST. The provision related to that, you must have studied in the GST while studying the GST law, that the two situations are there, two scenarios are given to the exporter. One is like you can give the IGST on exports also and take the take the refund of that. Whatever IGST you are paying on exports, you are eligible to take the refund of that. Second thing is a certain bond, LOU is an understanding is signed with CBIC that they are going to export this value of this document. Matlab, the value of these shipments having this much value. They sign an understanding with the customs department. Once that understanding is built, it is signed, no IGST is levied on the invoice. So on the face of the invoice, you will not see any value against the IGST.
Okay.
So these two
Otherwise,
options are always there. So this provision is there in the GST law itself. Custom Act, nowhere it is considered, nowhere it is shown. Okay.
on reverse charge mechanism, we can also charge, na, on export.
No, there is no question of reverse charge. Matlab, how you want to, can you please explain a bit like how the reverse charge become applicable in case of exports?
Charge the IGST, and then we can claim it as a.
Ha,
Uh,
but you cannot just say that it's a reverse charge because these are the technical terms and used in their given framework itself. Their understanding is interpreted as given in the law itself. So in
Thank you.
case of the export, you can charge when LOU is not signed. Then yes, always on the face of invoice you will see IGST has been charged, and then refund word is being used that what all IGST is charged or paid while exporting the goods, you can apply for the refund of that. It will not, because when once you use the word reverse charge, then the meaning and understanding anyone will interpret in the same manner as it is interpretation given under the law. Okay.
Okay, ma'am. Thank you. Thank you.
Ah, thank you. You're welcome. Thank you. So now moving ahead, we'll just go through example quickly. Just go through example 11. Okay. So now, um, in this given question again, an exporter. Okay, now it is a question of export. Exports valuing INR 1 lakh to United States by a vessel. Other details are as follows. So in this question, since the accessible value of exports is given in INR, there is no information required related to exchange rate. Only in this question, we are going to identify the rate of export duty. So they have given the date of shipping bill. They have given the date of the entry outward when it is granted by the customs. They have given the date of ship let for USA for the Indian from the Indian port. Matlab, when the ship has left from the Indian ports for USA. Fourth date is ship crossed the territorial waters of India. They have given the four dates. So every date is carrying certain any given export duty as defined by CBIC, as identified by CBIC. LEJ. So which custom rate you are going to consider in these 4 scenarios. Say suppose these 4 dates are given, which is the export, sorry, I used custom duty, which is the rate of export duty we are going to apply in this case. Yes, because under section 50, it is clearly stated, one line explanation is there, always it is the rate of entry out. So we are going to use the 8%. Act never talks about given ship vessel leaves from Indian ports. Act is not talking about when Indian vessel or the vessel leaves the territorial waters. It is only talking about the entry outward, and yes, the shipping bill is also there in for the exchange rate purposes. Hope clear till now? So there is only one case study that has been referred in your books. You can just mention, keep your notes ready, that yes, few of the cases which you know that such questions are going to definitely going to come. So learn at least few those cases. You can easily mention in your exam. So in this circular number 18 of 2018 dated 10th November 2018 means just for the uh, duty purpose only, what is the actual transaction value, because you have identified the export duty, but the transaction value should also be accurate on which the duty is applicable. So that says that the price actually, that is, what is the transaction value? It is the price actually paid or payable for the goods for delivery at the time or place of exportation under section 14 of Custom Act. So that means they are saying that we should always consider the price that is decided for delivery, that can be actually paid or payable, because at times the transaction happens in advance payments also. Okay, so that is why they have written that is the actually paid or it is payable, but that price is the price for delivery. Okay, and it should always be on FOB price of such goods at the time and place of exportation. Means this amendment has been made specifically for when you are okay. Matlab they are generally covering exportation, means exportation of anything, any goods, any goods, exportation. It's not about exploration. I just got a bit tricky if they are talking out about any exploration. No, it is only exportation. So any type of exportation. Okay. So they have just given an example. If the transaction value is 100 of FOB and the duty rate is 15%, the export duty will be 15% of FOB price, that is rupees 15. In case the transaction is on CIF value, that's what I have just explained, then the FOB price may be reduced, means you have to work out the FOB value out of the CIF value by deducting this 15 rupees charges in the given example, and you will again land back to 100 rupees. That is your FOB value. Hope it is clear. Hope it is clear. Okay. So entry inward to the vessel we have just studied. We have studied. Okay. And entry outward. Entry outward also we know what is the document. It is one of the document that helps, that is issued by the proper officer. Once it is satisfied, once means entry outward, it's outward document has been raised, it means the goods has been clear. The clearance to the goods has been given by the proper officer. Now, they are just trying to give a one of the provision that yes, this entry outward can be issued in advance also. So the vessel should be granted entry outward. Loading can start only after entry outward is granted under section 39 of the Customs Act 1962. Steamer agent can file application of entry outward 14 days in advance so that intending exporter can start submitting shipping bills. This ensures that formalities are completed as quickly as possible and loading in ship starts quickly. Why they are trying to say is like when you are doing a big consignment, one big container you want to stuff in. So there can be multiple shipping bills related to that. So what the steamer agent do on behalf of the exporter, they raise a request 14 days in advance from where the vessel is intended to move. They just apply for the entry outward, and if they get this entry outward raised from the department, then they can just start stuffing, loading the uh, shipment to the vessel. And later on what they are doing is they can raise the shipping bill. They keep on raising the shipping bill during these 14 days so that final date they will be able to deliver all the goods and those can be loaded. So this is the process, this is the provision given under section 39 of the Customs Act, where the shipping bill is presented prior to the date of the entry outward. Then for the purpose of working out the exchange rate or anything, it is presumed that the date of shipping bill will be the same as of the date of entry outward. Okay, and the exchange rate will be considered on that day. See, theoretically things are different, and when we are dealing practically, the things are different. So when we are practically dealing, and it comes that shipping bill has been raised earlier, but it has been like the date of entry outward is later, then for the purpose of the exchange rate we will just presumed. Okay, no, so sorry that this section, why we are presuming that the bill of a shipping bill, sorry, I'll just go through this provision. If the shipping bill has been presented before the date of the entry outward of the vessel by which the goods are to be exported, the shipping bill shall be deemed to have been presented on the date of such entry outward. The provision of this section shall not apply to baggage or goods exported by post. That means certain exclusions have been given. This is clear that yes, if shipping bill has been presented earlier before the entry outward, then the date of shipping bill will be same as that of the entry outward. But for the purpose of the baggage and any goods are exported by post, the provision will not applicable. Then the shipping bill date will be different and the entry outward date will be different. Okay, now the rate of duty and tariff valuation for imported goods. That we have just studied. We have studied, covered in very detail. We have studied na ki when the goods are cleared for home consumption, bill of entries raised for home consumption. When it is bill of entries raised, clearance is made for warehousing. They have just presented this thing in a tabular form. If you want to give a reading, just quickly give a reading. Okay. It is going to, like, the meeting is going to end because it is limited to sorry, till 8 only. Hope till this it is clear to all. If just give a quickly this reading to this table, and what I feel is that we can just continue with the 1.4, that is circumstances under which no duty will be leviable. Okay, fine. I'll just quickly cover this thing. Meeting automatically gets cancelled if it reaches the meeting time. Are you able to hear me?
No, it
Oh,
could be
okay.
continued
Huh?
convenience. It could be continued at your convenience.
It can be continued. Okay, okay, fine. So quickly we will just go through this 1.4 because it is related to the circumstances we have studied, read about when we can levy the custom duty. There are certain situations when we are not supposed to levy the custom duty. Like if there is any pilferage happened, if there is any damage happened while shipment, while on the in the vessel itself, some fire has occurred, or some part of the consignment has damaged, destroyed, or while unloading it has been damaged, or while the goods were lying in the warehouse, the goods were got damaged. So anything, if any such thing has happened, what all goods has been destroyed, which are not in position to be used, no custom duty will be levied on such goods. Right? Clear? Till fourth I have covered. So they have given on fifth point, they have just specified certain more criteria. I'm just going to read that. No duty will be levied in case of goods abandoned by importer. Abandoned by importer means importer does not want to take the possession of those goods. They just don't want to get the goods cleared. They don't want to take the delivery of those goods. Why importer do so? Because at times the goods may not be according to the specification. So there is no compulsion that what all goods uh, have been received at the port. The importer is uh, perforce has to take the delivery of the goods, because when you practically deal with these scenarios, you have to give the confirmation to the bank also while making the releasing the payments, and to the custom authorities also, that yes, the goods are as per specifications which has been decided when the order was placed. So if there is any variation, discrepancies in the specification, the importer has full right to relinquish, to leave, not to take the delivery of that consignment. Second second point can be, scenario can be, the goods may have been damaged during voyage. The complete consignment got damaged. So the importer has a say, he can say no to take the delivery of such goods. There might have been breach of contract at any point. What all terms and conditions of the contract has been agreed upon between the buyer and seller. Few of the maybe terms and conditions has been breached during this entire process. In that case also, importer one abundance to take this delivery, then no custom duty is charged on such goods, on such shipment. So the importer has a complete right to relinquish his title to the goods unconditionally. Means no condition can be imposed. Okay, and this relinquishment is done by endorsing the document of title to the goods in favor of Commissioner of Customs along with invoice. Means they just endorse, the importer just endorse the title of the goods to the Commissioner of Customs. That is why at times if the goods are can be used for end use purpose, they just give it a very nominal prices and release in the market. So no duty will be leviable if the central government is satisfied that it is necessary in the public interest not to levy import duty by issuing the notification in the official gazette. Hope it is clear till now. Okay. Hope it is clear. Chetan, you have said no, ma'am. I am. Why you said no, ma'am? Sorry, I read it just now. Hope, Chetan, till now what we have studied, it is clear. So, from this transit of goods, and I think so, we are just at 6:25. Few things are left. The note gets completed. There are, says, eight to nine few pages are there. When you ask for automatically of this lecture. Okay, thank you, Chetan, for clarifying this. So there are few more points are remaining. So we will close this in the next, and we'll immediately start with the next note. Okay, it only explaining the transmission of goods and uh, transit about goods. That when the goods are in transit, what are the provisions under custom acts, and what is the transmission of goods. Okay. So we will cover these 2 points, and we'll start with the next note in the coming class. And one of the class that we have missed in the previous one, it is going to happen once all your lectures are there, or once custom we are going to finish. I'm going to take one extra class for that. So shall we close the class? Thank you so much, Urvashi.